Welcome. Today, we're diving into a really fascinating challenge. How do companies that buy enormous amounts of gold and silver protect themselves from those crazy price swings? Now, we're not talking about investing. Nope. We're looking at the strategic world of corporate procurement, where the main goal is just to keep the business on an even keel, not to strike it rich on the market. The first question anyone asks about gold and silver is always something like, so where's the price headed next? And yeah, that makes sense for an investor or a trader, but for the people who are actually buying these metals to make things, like jewelry or electronics, it turns out that's completely the wrong question to be asking. See, for a corporate procurement team, the job isn't to gaze into a crystal ball. The real goal is to create predictability and control in a market that, let's be honest, doesn't offer much of either. It's all about managing risk, not making a bet. And that gets us right to the heart of it. The real problem for these teams isn't whether the price is high or low, it's volatility. It's the wild, unpredictable swings that can absolutely shred budgets and turn financial plans into complete chaos. Now, what's so telling about this list is that none of these things are within a company's control, right? A procurement manager can't influence what the Fed does with interest rates or stop a geopolitical crisis. These are massive external forces creating waves that can slam right into their profit margins. So here's the key shift in thinking. Procurement professionals, they don't just see a price chart with a line going up and down. They see a direct threat to their business. Every little tick up or down on the market is a potential hit to their budget. Their job is to translate all that market noise into a quantifiable business risk. So how do they actually fight back against all this uncertainty? Well, the first line of defense comes down to a really fundamental choice in how they buy. This is pretty much the first big decision every team has to make when they're dealing with commodities like gold and silver. And this slide lays out the classic trade-off perfectly. On one side, you've got spot buying. That's basically just buying at whatever the market price is today. It's super flexible, and if prices drop, great. But if they spike, your budget is completely exposed. On the other side, you've got hedging. That's where you use financial tools to lock in a price for the future. It gives you certainty, protects the budget, but you lose that flexibility, and yeah, you might miss out if prices take a nosedive. So how on earth does a company choose? Well, it really comes down to their specific DNA. How predictable are their sales? How much would a sudden price jump hurt their profits? And maybe most importantly, what is the company's official appetite for risk? The finance and procurement teams have to be in lockstep on this. Okay, so beyond how you buy, there's the question of what you agree to. This is where we get into the nitty-gritty of supply contracts, because this is where risk gets formally divvied up between the buyer and the seller. This is so important. Buried deep inside those long-term contracts are things called price indexation clauses. You can think of them as the official price-setting rules for the entire deal. And the way these rules are written literally decides who has to bear the financial pain if prices spike. Is it the buyer or is it the supplier? And a really well-crafted clause is incredibly specific. It won't just say market price. It'll point to a clear, trusted benchmark like the LBMA in London or the MCX in India. It'll spell out averaging periods. Are we using the price from one day or the monthly average? And sometimes it'll even include things like price caps or floors to limit the exposure for everybody involved. And this quote just hits the nail on the head. Building these clauses isn't just a job you hand off to the legal team to check the fine print. No way. It is a core strategic skill for procurement leaders. This is where they can create tremendous value and stability for the business, long before a single ounce of gold even shows up. Okay, so that's the theory. But what does this look like in the real world? Let's check out some major Indian corporations and see exactly how they put these risk management ideas into practice. First up, Titan Company, an absolute giant in the jewelry business. For them, the challenge is just pure scale. They buy such huge amounts of gold that even a tiny little price change can mean a massive financial hit. So to manage this, Titan uses a whole toolkit. They have structured hedging programs to lock in prices, they keep incredibly tight control over their inventory to minimize what's exposed to the market, and they have clear systems to pass price changes onto customers. The lesson here is crystal clear. When you're this big, you cannot afford to gamble. You have to manage your exposure like a science. Next, let's look at Rajesh Exports. They're a major gold refiner and exporter. Now, their business runs on super, super thin margins. For them, the absolute price of gold isn't the main worry. It's the spread, that tiny difference between their buying and selling price. So their strategy is all about minimizing what they call open price exposure. They are constantly, and I mean constantly, working to match what they're buying with what they're selling and using hedging to plug any gaps. It's an unbelievably disciplined process. And what we learn here is that in a business like this, the skills of a procurement team start to look a whole lot like the skills of a financial trading team. All right, here's a different perspective. Hindustan Zinc is mainly a zinc producer, but silver is a huge byproduct of their mining. So in this case, they're the seller. But they face the exact same problem. Price volatility makes it impossible to forecast their revenue accurately. So what do? They use tools like forward sales contracts to lock in prices for what they're going to produce in the future, and they build those averaging mechanisms right into their sales agreements. Their entire focus is on making their revenue stream predictable. It just goes to show you, these risk tools are vital whether you're buying or selling. And finally, let's bring it all the way down to the customer with Tanishq, the famous retail jewelry brand from Titan. Their challenge is all about maintaining stable and fair prices in their showrooms. I mean, you can't go around changing thousands of price tags every single time the market jitters. Their strategy is a fantastic example of retail discipline. They manage how quickly their inventory sells, they have systems for daily price adjustments that are transparent to customers, and they'll use some partial hedging when the markets get really choppy. The key takeaway here is so powerful. Strategic procurement isn't just about getting materials, it's about protecting the brand's profits and its trust with customers. So when you pull all of this together, you see the real mission behind all these strategies. It's got nothing to do with being a market guru. It's about building a financial shield around the entire business. Because at the end of the day, that's the bottom line. If the procurement team doesn't manage price risk out in the supply chain, that risk doesn't just disappear. It flows straight to the company's income statement, and it shows up as volatile, unpredictable earnings, which is something that makes investors very, very nervous. And that really leaves us with the most important takeaway of all. In this high-stakes world of buying commodities, winning isn't about making a lucky guess on which way prices are headed. It's defined by discipline, by strategy, and by the smart design of systems that shield the business from uncertainty. It's all about controlling what you can control, not trying to predict the future.